Hi, this is Ümmü Gülsüm Zor, and this is the fifth and the last part of the financial literacy course. In this part, we will talk about savings, investment, and retirement plans. According to the Cambridge Dictionary, saving means the money that a person has in their account, in a bank or a similar financial organization. Saving might also be considered as the wealth accumulation for future simply because every dollar amount that you will be saving from today will be accumulating over time, and you will be it is going to mean some wealth for your future. Some facts about savings is there any available cash in your hand may allow you to take advantage of immediate opportunities that might arise in the future. And today's excess cash will be providing you future financial security for unexpected cash needs in the future. Remember that immediate needs always cost more than they would cost in normal times, because when there is an immediate need, you will be willing to take greater amounts of, let's say, interest rates if you're getting a bank loan for your emergent needs. This is the insurance. So, and in addition to insurance, you can also rely on your savings. As a difference from the saving, investment refers to an act of keeping money or investing money in something, like putting money or effort or any type of resources that you can have into something to make a profit or to take an advantage or to get some extra money or to get some effort, time, and so on. The major difference from the saving is that the money used for investment is actually used for funding some productive uses. Also, saving has no risk of losing money because simply you're keeping your money with an interest rate in a saving account at a bank. However, there is a least risk of losing money for investment because simply no matter what you're investing, there is a great chance, there is a chance that the business is not going to be successful. Well, starting saving or investment at young ages is always better than starting later on because of the time value of money. The $1 that you're going to be saving today is not going to be $1 next year because of the time value of money. Compound interest will be snowballing your money over time. So you will have $1 today, next year it's going to be, let's say, $1.20, and the interest rate will be applying to the accumulated amount, not the basis or not the principal. And even for some small amount, there are many options for your investing your money rather than saving in an saving account. Remember that usually investment has higher interest returns as compared to the saving account. Some of the options available for individuals are CDs, loan platforms, and stock market. If we talk about CDs, usually these are the certificate of deposits that are offered by government agencies. And they offer a useful method for growing small investments safely. There is usually no risk, and the fixed rate of interest is usually higher than the saving account. There is a specified period of time for CDs. It might change from 3 months to 5 years depending on your preference. So this is maybe the easiest step to start with. On the other hand, you can also use business and consumer loan platforms. There are some online platforms as well that you can invest your money. You can start with as little as $25. There are some companies like Lending Club and Prosper as well. And these type of platforms are going to allow you to diversify your investment into different portfolios that you're going to be choosing. The good part is that you can start analyzing what's going on in the market or in this type of platforms by investing small amounts. And also the good part is that your return will be paid back on a monthly basis. So every month you're going to be getting some return on your investment. Another option that you might prefer is stock market investment. I would suggest you to go with small amounts so you can learn about the dynamics of the stock markets yourself. And online stockbrokers can help you to do trading yourself, so you can do research, choose, buy and sell stocks, options, funds, or so on by your own. So these are the available options with small amounts for you to start with investments. You can take any actions, but usually, it is better to start with saving in a saving account. Then once you have some sufficient amount, you can also start with investment as well. So take your steps slowly, go step by step to improve your financial position. And also retirement. Retirement is something that, especially for young generation, is not never going to come true. Well, however, even though it seems kind of far away for us now, time is flying very quickly. So it is going to be coming at some point. And if we do not plan if we do not start planning from today, so probably tomorrow will be too late for us. Therefore, I would strongly suggest you to also plan your retirement from today. Retirement planning is a process actually to decide about how much income that you are looking for when you get retired and how you're going to be making this amount. It includes identifying source of income, estimating some expenses as well, and implementing a saving program and managing assets and risk through this program. Simply, you can start with saving account, and then based on that saving account, you can start making some investment. In most of the countries, when people get their age of, let's say, 40, they go to purchase some houses to secure their at least housing needs for future. In some countries, like Turkey that I live, people like to purchase more than one house to lease them out so they can get some rental income as well. Depending on your preference, you can start with small amounts again with the investment, and you can always save some small amounts for your retirement. Even though it seems too far right now for you, it is best to start earlier. Besides what you're going to be preferring for your retirement plans, it is always great to start with personal preference. But many countries have different laws and regulations for retirement. Even though, most of them actually obligate the employers to offer pension plans for employees. And also there are some individual pension plans available through banks, social security, and similar organizations as well. So you can also check for them. Well, usually, as I said, a saving account is the best first step for a young individual to start with. To start with budgeting and saving, planning for future, doing some, invest some small amounts into something that you prefer, and plan for your retirement. These are the basics of financial literacy course. I hope this course will be helpful for you. Thanks for participating. This is the end of financial literacy course. Bye.